Why do so many people misunderstand what really holds the world together? Why do intelligent investors, experienced policymakers, and thoughtful observers keep focusing on the visible surface while missing the quieter forces underneath? When people talk about the U.S. dollar, they often talk as if it were a symbol, a flag, or a guarantee. But money doesn't work because of symbols. It works because of confidence moving through systems, and systems don't respond to belief the way people think they do. The question I always come back to is not whether the dollar is strong or weak. It's why capital chooses to flow where it flows. Why, in moments of fear, money still tends to move toward the same places. Why confidence once established can persist far longer than logic suggests and then slowly, almost politely, begin to drift away without anyone announcing that it has. There is a lesson in that pattern that took me years to understand. I didn't learn it from success. I learned it from being wrong while feeling certain I was right. When I was younger, I believed capital moved primarily in response to ideas. The best argument would win, the most elegant analysis would attract money. I thought if you understood the numbers deeply enough, capital flows would make sense. And for a while, that belief seemed to work. But over time, I began to see that capital is less intellectual than we like to imagine. It moves towards safety, liquidity, familiarity, and the perception of continuity. Those things are emotional as much as they are rational. I learned this lesson painfully in the early years of Bridgewater. I had built a view about where the economy was heading and positioned for it with conviction. The logic was clean. The framework made sense. But the capital didn't behave the way I expected. Money moved in directions that seemed irrational to me at the time. Instead of questioning my assumptions about how capital behaves under stress, I questioned the intelligence of the market. That was a mistake. Markets are not wrong. They are revealing. The period that followed forced me to confront something uncomfortable. Capital doesn't wait for clarity, it reacts to uncertainty. And when uncertainty rises, it doesn't ask who is most correct. It asks who is most dependable. Where can I go quickly? Where can I exit easily? Where will others also go when fear spreads? Those questions shape flows far more than forecasts do. I remember sitting alone after that failure, looking back at my reasoning and realizing that I had confused my confidence with the world's confidence. I assumed that because my logic felt solid, others would see it the same way. But confidence is not shared equally. It is collective and it is contextual. It forms slowly through repetition and it breaks slowly through accumulation. That realization changed how I looked at money entirely. Money is not just a store of value. It is a social agreement reinforced by habit and reinforced by scale. The U.S. dollar benefits from something that is hard to replicate, deep liquid markets, a long history of enforcement, and a global system built around its use. Capital flows into the dollar not because it is perfect, but because it is familiar and usable at size, especially when things feel unstable. What many people miss is that dominance is not maintained by brilliance. It is maintained by reliability. When capital moves across borders, especially in large amounts, it doesn't seek the best idea. It seeks the least friction. It seeks the place where rules are known, exits are available, and others will also be present when conditions worsen. I didn't understand this fully until I watched capital behave in ways that contradicted my expectations. During periods of global stress, I expected diversification to pull money evenly across alternatives. Instead, I saw concentration increase. Capital flowed toward the dollar even when the problems originated in the U.S. That felt paradoxical until I realized that in moments of fear, people prioritize survival over optimization. They want to know they can get out, not that they will make the most. That principle applies far beyond currencies. It applies to careers, to relationships, to institutions. When pressure rises, people retreat to what they trust to still function. Trust is built slowly. It is not erased by a single flaw. It weakens when alternatives begin to feel viable and when confidence and continuity starts to fray. The danger is assuming that because trust has endured, it is permanent. I made that mistake early in my career. I assumed that because a framework had worked, it would continue to work unchanged. Reality corrected me. Systems don't fail because they stop working. They fail because conditions change and behavior doesn't. So when I think about what keeps the dollar dominant, I don't think about strength in isolation. I think about relative strength, about the alternatives, about the costs of moving away, about the inertia built into global systems. Capital flows are shaped by comparison, not absolutes. The question is never is this good, but is this better than the rest given the current environment? There is something humbling about watching capital move. It doesn't argue, it doesn't justify. It reveals preferences through action. And if you pay attention, it teaches you how the world really works, not how you wish it worked. I had to learn to listen to that lesson instead of resisting it, to stop asking why capital should behave a certain way and start asking why it does. That shift changed how I approached every macro question afterward, including this one. As I started to pay closer attention to how capital actually moves rather than how I thought it should move, something else became clear to me. Confidence is not an abstract idea. It is built into structures, into plumbing, into habits that form over decades. People talk about trust as if it were a feeling, but in markets, trust is operational. It's about whether things work when they are stressed. I remember a period after we had rebuilt Bridgewater when global markets were relatively calm on the surface but fragile underneath. You could feel it if you listened carefully. Volatility was low, spreads were tight, and confidence felt abundant. Those are often the moments when people stop asking hard questions. They assume that because things are quiet, they are safe. I've learned to be most cautious during those times because that's when imbalances grow unnoticed. Capital flows during calm periods are often driven by yield. People look for return. They move money into places that promise a little more. But when uncertainty rises, yield stops mattering. Liquidity matters. Safety matters. Familiarity matters. And this is where the dollar's role becomes clearer. The U.S. dollar sits at the center of an enormous network. Trade is invoiced in it. Debt is issued in it. Assets are priced in it. When stress appears, people don't have time to redesign the system. They use what exists. They use what scales. That embeddedness creates a kind of gravitational pull. Capital doesn't rush toward the dollar because it is flawless. It rushes because it is there, because it is deep, because others are already there. I didn't fully appreciate the power of that inertia until I saw capital behave in ways that contradicted common sense. During periods when U.S. deficits were rising, when political dysfunction was visible, when headlines were negative, money still flowed toward U.S. assets. That confused me at first. I thought confidence should break under that weight. But confidence isn't about headlines. It's about comparison. Investors don't ask, is this system perfect? They ask, where else can I go with this much capital and this much urgency? That's a much harder question. Alternatives exist, but they often lack depth, transparency, or the legal and institutional continuity that large pools of capital require. When you're managing serious amounts of money, you care less about being early and more about being able to move without breaking things. This realization forced me to revisit some of my own assumptions. Early in my career, I believed that if you identified weaknesses clearly enough, capital would respond immediately. I underestimated how sticky systems are, how much friction exists in changing behavior at scale. The world doesn't pivot because a chart looks convincing. It pivots when incentives, constraints, and confidence align. There was a moment when I looked back at one of my wrong macro calls and saw it differently. I had been right about certain long-term pressures, but wrong about timing. I expected capital to react to imbalances before it was psychologically ready to do so. That impatience cost me. It taught me that being early can feel exactly like being wrong, and in markets, the distinction matters. That lesson applies directly to thinking about the dollar. Long-term pressures can exist alongside short-term dominance. Those two realities are not contradictory. They coexist for long stretches of time. The mistake is assuming that one invalidates the other. Systems don't flip like switches. They bend, they stretch, they adapt. And as long as they adapt well enough, confidence remains. Another thing I began to see is how much the dollar benefits from the structure of global fear. When uncertainty rises anywhere in the world, it creates demand for a neutral medium, not neutral in values, but neutral in function. Something widely accepted, easily exchanged, and supported by institutions that have weathered crises before. That demand reinforces itself. The more it happens, the more it becomes expected. This feedback loop is powerful. It means that stress elsewhere can strengthen the dollar even when the source of stress is not external. That's counterintuitive, and it's why simplistic narratives about collapse miss the point. Dominance is not just about internal strength, it's about relative reliability in a world full of imperfections. I've also noticed how confidence erodes not through panic, but through options. When alternatives slowly improve, when systems diversify quietly, when the need for a single anchor lessens, capital begins to explore, not flee, explore. That exploration doesn't make headlines. It shows up as marginal shifts, a little more diversification, a little less concentration. Over time, those margins matter. This is why I've learned to watch flows rather than statements. What people say about money often reflects what they want to be true. What they do with money reflects what they actually believe. When large institutions adjust portfolios gradually, when reserve managers diversify incrementally, when trade settlement evolves slowly, those are signals, not of collapse, but of reassessment. There's a personal parallel here that I can't ignore. In my own life, the biggest changes didn't come from dramatic decisions. They came from quiet realizations that accumulated until a new behavior felt natural. Confidence shifted before action did. Action followed understanding, not the other way around. If there's something practical in this for you, it's to pay attention to how systems behave under stress, not how they are described during calm. Whether you're thinking about money, your career, or your own beliefs, stress reveals structure. It shows you what is relied upon when things are uncertain. That information is far more valuable than any forecast. As I've aged, I've become more patient with these processes, less eager to declare turning points, more interested in whether the underlying mechanics are strengthening or weakening. That patience didn't come from wisdom. It came from having been wrong enough times to respect how long it takes for deep systems to change. Over time, I began to notice that most debates about currencies miss the quiet center of the issue. People argue about policy choices, political decisions, or short-term market reactions, but capital doesn't move because of arguments. It moves because of constraints. It moves because of what is possible at scale under pressure with imperfect information. Once you see that, the conversation changes. There is a tendency to think of confidence as something psychological, almost sentimental, as if people simply wake up one day and decide they no longer believe. That's not how it works. Confidence is embedded in routines, in systems that function day after day, in settlement processes that clear without friction, in legal frameworks that hold even when disputes arise, in markets that remain liquid when fear spikes. These things don't show up in headlines, but they are what capital pays attention to. I learned this lesson again and again by watching how stress moves through the global system. When pressure appears, it doesn't disperse evenly, it concentrates. It looks for weak points, it tests assumptions. And in those moments, what matters most is not theoretical strength, but operational resilience. Can trades clear? Can assets be sold? Can obligations be met without delay? Those questions are answered not by ideals, but by infrastructure. At Bridgewater, we spent years trying to design systems that would function when our assumptions were wrong. That sounds obvious, but it runs against human instinct. Most people design for the outcome they expect, not the one they fear. I did that early on and I paid for it. I built positions that worked beautifully if the world behaved as I thought it should and collapsed when it didn't. That experience taught me to value robustness over elegance. The same principle applies to currencies. The dollar's dominance isn't about perfection, it's about robustness. It has flaws, it has imbalances, it has political complications, but it also has scale, depth, and continuity. Those qualities matter most when systems are stressed. Capital flows toward what can absorb it without breaking. Another thing that becomes clear when you study flows over time is how rarely change begins at the center. Shifts usually start at the margins. A little diversification here. A new settlement mechanism there, an alternative tested quietly without fanfare. At first, these changes don't threaten the dominant system. They coexist with it, they learn from it, and only much later do they begin to matter in aggregate. This is why people who expect sudden reversals are often disappointed. They look for moments of drama. They miss the slow accumulation of optionality. They underestimate how long it takes for trust to migrate and how quickly it can move once enough pathways exist. That timing gap confuses people. It makes them oscillate between complacency and panic. I've seen this dynamic play out in my own thinking. There were times when I identified a long-term pressure correctly but acted too early because I underestimated inertia. I mistook fragility for imminence. That's a subtle but costly error. Systems can be fragile for a long time before they fail, and strong systems can absorb a surprising amount of stress before changing behavior. When I think about the dollar through this lens, I don't see a single force determining its future. I see a balance of forces: productivity and debt, innovation and demographics, institutional continuity and political noise, global integration and fragmentation. None of these operate in isolation. They interact, and their interactions matter more than any one variable on its own. There is also a human element that often gets overlooked. Large pools of capital are managed by people whose primary responsibility is not to be visionary, but to be prudent. They are judged not on whether they anticipate the future perfectly, but on whether they avoid catastrophic mistakes. That incentive structure favors familiarity and liquidity. It discourages abrupt change. Understanding that helps explain why capital often moves more slowly than commentary suggests. I think back to moments when I felt the urge to act decisively to make a bold move based on a clear conviction. Sometimes that urge was justified. Often it was driven by discomfort with ambiguity. Over time, I learned that ambiguity is not a problem to be solved. It is a condition to be managed. Capital behaves the same way. It doesn't rush to resolve uncertainty, it positions around it. If you are listening to this and trying to understand what all of this means for you, I would suggest paying attention to where flexibility exists in your own thinking. Ask yourself where you are assuming continuity without questioning the mechanics that support it. And ask where you might be overestimating how quickly change happens. Those two mistakes often appear together. The longer I've done this, the more I've come to appreciate that dominance is not a static state. It is an ongoing process of meeting demands under stress. The dollar continues to do that better than most alternatives, which is why it remains central. But that centrality is maintained, not guaranteed. It depends on choices, on adaptation, and on the relative evolution of the rest of the world. Seeing it this way has made me less interested in predictions and more interested in preparedness, less focused on outcomes and more focused on exposure. That shift has influenced not just how I think about currencies, but how I approach life more broadly. As these patterns became clearer to me, I also became more aware of how much noise we mistake for signal. We live in a world that reacts instantly. Prices move in milliseconds. Opinions spread in seconds. But the forces that sustain dominance operate on a different clock. They move slowly enough that impatience becomes a liability. That realization changed not just how I think about markets, but how I think about my own reactions to them. There was a time when I felt compelled to respond quickly, to take a stance, to have a view ready. Silence felt like uncertainty, and uncertainty felt like weakness. Over time, I learned that silence can also be discipline. It can be the space where observation replaces impulse. That's where real understanding tends to form. When you watch capital flows over decades rather than days, you begin to see that confidence is cumulative. It's reinforced every time a system works under stress, every time a transaction clears without friction, every time obligations are honored when it's inconvenient to do so. These small confirmations compound. They create habits, and habits are powerful. They don't disappear because of a single shock. They fade only when repeated experiences suggest there may be better options. This is why the question of what keeps the dollar dominant is inseparable from the question of alternatives. Not theoretical alternatives, but practical ones. Can they handle volume? Can they handle stress? Can they handle disagreement? Can they function when conditions are unfavorable? Until those questions are answered convincingly, capital will continue to rely on what it knows works, even if it is imperfect. I've also noticed how easy it is to confuse criticism with fragility. A system can be criticized openly and still function effectively. In fact, the ability to absorb criticism without breaking is often a sign of strength. Transparency, dispute resolution, and the rule of law don't eliminate conflict, but they provide channels for it. Capital values those channels more than it values harmony. There were moments in my career when criticism felt threatening, when disagreement felt like instability. Those were the moments when my thinking was most fragile. As I matured, I learned to separate challenge from danger. I began to see that systems improve when they are tested, not when they are protected from discomfort. The same applies to currencies. Stress tests reveal structure, they don't automatically destroy it. Another quiet factor that sustains dominance is coordination. When many actors are aligned around a common medium, switching becomes costly, not just financially, but operationally. Contracts, systems, and expectations are built around what exists. Changing that infrastructure takes time and effort. That inertia is not glamorous, but it is real. It explains why transitions are slow even when pressures are visible. In my own life, I've seen how long it takes to change deeply held habits, even when you know they are no longer optimal. You don't wake up one day and become someone else. You shift gradually as new behaviors prove themselves reliable. Systems behave the same way. They don't abandon what has worked until something else has demonstrated it can work as well consistently under stress. This is why I'm careful not to frame the future in absolutes. Not because I want to avoid commitment, but because absolutes rarely survive contact with reality. The world we live in is shaped by trade-offs. Stability comes at the cost of flexibility. Flexibility comes at the cost of simplicity. Every system balances these tensions differently, and those balances evolve over time. If there is a practical way to hold all of this, it's to focus less on predicting turning points and more on understanding dependencies. Ask what relies on what. Ask what assumptions are embedded in your decisions. Ask how those assumptions would hold up if conditions change gradually rather than suddenly. Those questions don't give you answers, but they give you resilience. As I've grown older, I've found more value in alignment than in certainty. Alignment with reality as it is, not as I wish it to be. Alignment with principles that guide behavior under uncertainty. That alignment has helped me navigate periods when clarity was unavailable and patience was required. The future of the dollar, like the future of any dominant system, will be shaped by how well it continues to meet the needs placed upon it. Not perfectly, but adequately. Not forever, but for as long as alternatives remain less convincing. That process is ongoing. It doesn't announce milestones. It simply unfolds. As I bring these thoughts together, I notice how my relationship with questions like this has changed. Not because I've found better answers, but because I've learned to live with the kind of uncertainty they carry. Earlier in my life, I would have wanted this reflection to land on a conclusion, a clear position, something definitive enough to act on. Now, what feels more honest is leaving space for reality to keep unfolding. What keeps the U.S. dollar dominant is not a single advantage, and it's not a moral judgment about what should be. It's a living system of confidence, habit, infrastructure, and relative reliability. That system has endured not because it avoided stress, but because it absorbed it again and again, each time reinforcing a pattern that capital has learned to trust. That trust is not blind, it is conditional, and it persists only as long as the conditions that support it continue to function. I've spent enough time watching systems evolve to know that endurance often looks boring from the outside. It doesn't announce itself, it doesn't celebrate. It just keeps working quietly under pressure. And when it stops working, it rarely does, so all at once. It hesitates, it frays at the edges, it invites alternatives to test themselves. Only later does it become obvious that something meaningful has shifted. In my own life, the moments that mattered most weren't marked by certainty, they were marked by attention. By noticing when something that once felt reliable began to feel strained, by listening when outcomes no longer matched expectations, by being willing to pause instead of pushing harder in the same direction. That willingness didn't make me passive, it made me adaptable. I think that's the most practical lesson here, even if it's not dramatic. Whether you're thinking about currencies, markets, or your own path, pay attention to what people rely on when conditions are difficult. Watch where confidence actually goes, not where it is said to be. Notice what continues to function when incentives are distorted and emotions are high. Those observations tell you far more about the future than confident statements ever will. There is also a quiet humility that comes with recognizing how small our individual timelines are compared to the systems we inhabit. The dollar existed before most of us began paying attention to it, and it will continue to change in ways that extend beyond our own decisions. That doesn't make our choices irrelevant. It makes them contextual. It reminds us that alignment matters more than control. As I've grown older, I've felt less need to prove that I understand where things are going and more responsibility to understand how things work. That shift has made me calmer, not because the world is simpler, but because I'm less attached to needing it to be. Confidence, I've learned, is not about being certain. It's about being prepared to adapt when certainty dissolves. If you find yourself thinking about the future of money or the future of anything that feels foundational, I'd offer this quietly. Hold your views with enough conviction to act and enough humility to change. Pay attention to systems, not slogans. And remember that what endures does so not by resisting reality, but by aligning with it again and again. If you want to keep thinking with me, there's more to explore. The biggest mistake most people make is not learning how to think.